U.S. President Donald Trump announced last weekend he'd nominate former Federal Reserve Governor Kevin Warsh to head the U.S. Central Bank when Jerome Powell's term ends in May. Warsh served as the federal governor from the year 2006 through 2011, which includes the deep recession that followed the 2008 financial crisis. He has recently argued for lower interest rates, a view that aligns with Trump's push for the Fed to ease borrowing costs. His nomination now goes through confirmation by the U.S. Senate. If confirmed, he will need to act on inflation amid a weakened job market. So what does the nomination mean for the U.S. and the global economy? Let's loop in our panelists. In Shanghai, we're joined by Hu Jie, professor of practice at Shanghai Advanced Institute of Finance, or CIF, at Shanghai Jiao Tong University. He formerly worked at the U.S. Federal Reserve Bank of Atlanta as a senior financial economist. In New York, Anthony Chen, former J.P. Morgan Chase chief economist, and in Henderson, William Lee, chief economist and managing director of Global Economic Advisors. Gentlemen, what a pleasure to see all of you. Now, this nomination of Mr. Warsh certainly has stirred the market, according to some media reports. We have seen the precious metals such as gold, silver, and as well as some of the other fronts are going through some dramatic changes, especially decline. What does that say to all of us, Mr. Chan?
Well, I think the markets are somewhat of the view that Kevin Warsh, who has traditionally been a hawk, will in fact preserve the independence of the Federal Reserve and pay close attention to the inflation numbers. Keep in mind that Kevin Warsh was a former Federal Reserve governor, so he does have experience with the organization. And he also has the view that he wants to shrink the balance sheet. So all these things are viewed as potentially disinflationary, and therefore the allure of gold and silver is just a little bit less as the early perception.
Now, Mr. Lee, is it fair to link the latest price changes of all these precious metals and some other fronts to Mr. Warsh, or is it just a market analyst favorite to do so?
Well, I think today's reaction that we're seeing right now is partly a Warsh reaction because there's more certainty that he is the candidate. Up until now, for the last several weeks, you've had this rise in commodity prices, especially gold and silver, where people are just panic and say, let me just get out of fiat currency because I don't trust fiat currencies anymore. But with Warsh now on the horizon and in fact, squarely the nominee and has supported President Trump, we're going to see what he's going to bring, which what I call the Warsh maneuver. And the Warsh maneuver is he can actually lower rates the way President Trump wants so that mortgages and business loans can be cheaper, but he can contain the inflationary effects and in fact offset the inflationary effects of that by shrinking the balance sheet, as Anthony said. And we know that he'll do that and carry out that principle of containing inflation because he's a principled man.
Professor Hu, you've been listening to your U.S. counterpart discussing the latest maneuvers. What do you think, as an observer, what is going on with the choice of Federal Reserve Chairman in the U.S.? How does this politicization of the whole process and dramatization of it, whether it's in the media or behind the scenes, what does that say to you?
Anyway, every selection process has to consider the professional qualification. So the candidates' experiences, training, and the credibilities are always the foundational issue to be considered. I think Mr. Warsh, Kevin Warsh, has passed that, as I pointed out. And for this one, it's different by its own. In that everybody has seen President Trump has made such a big tension between himself and the Fed. I think this time the tension point is the interest rate. But fortunately, on this point, I think Mr. Warsh has shared the same view as the president. So this one is going to be resolved. Another thing to be noticed is that Kevin Warsh has shared the view with the president that the Fed needs to be reformed, even though maybe each person has different view on what need to be reformed. But anyway, reform itself is a common consensus at this point of time between the two.
We have seen media coverage, at least, talking about Mr. Warsh suggesting faster interest rate cuts. That's probably aligning him more with the U.S. President Donald Trump. But at the same time, he's also in favor of reducing the Federal Reserve balance sheet. What do these tasks mean for the policies change if he is being confirmed? Mr. Chan.
Well, there's some challenges there, and I think Bill Lee talked about the balance sheet, and that's a laudable goal. But keep in mind that when he basically became Fed governor in 2006, the balance sheet was about 6.4% of GDP. If you bring that balance sheet to 6.4% of GDP today, back then GDP was much lower, and today it's much higher, you would have a balance sheet of about $2 trillion. We have a balance sheet today of the Federal Reserve of $6.6 trillion. Lowering it to $2 trillion will be a challenge. Currency in circulation itself is already $2.3 trillion. So I think he would move in that direction to lower that balance sheet, but it's not going to be the same size of a balance sheet relative to the GDP number that it was in 2006. Because the world has changed. So it's a little bit more challenging. But at the same time, that is a goal. And I think it's probably a good thing, because why should the Federal Reserve be holding mortgage-backed securities? They probably should be holding only Treasury securities. And some Fed officials like Bostic of the Atlanta Fed has actually said the Federal Reserve should be holding Treasuries in proportion to the distribution of Treasuries in the marketplace, and therefore less involved with all these extra securities, and you can lower that balance sheet, but it's not going to go back to where it was in 2006 relative to the GDP number.
How much interest do you think is outside the United States about that balance sheet? And as a result, the role of the Federal Reserve, Professor Hu?
Well, every country is watching what's going on in the United States Fed. Yes, the balance sheet is too big. And by the way, when we go back to look at the tool set, balance sheet controlling as well as the interest rate controlling are both tools for controlling inflation. So it is a choice of which tool you use more. Each tool has its own characteristics, and the balance sheet expansion certainly benefits the investors more rather than the producers and the consumers, while the interest rate controlling benefits or hurts all the parties kind of equally. So by using balance sheet expansion less, is likely to be a more reasonable choice for the Fed in the future, as well as in the history. It's only in the past 10 years or so that the Fed has been using this tool a lot more than before. So I think it makes sense to shifting the policy tool emphasis on into interest rates more. I think it makes sense, but it's going to be a gradual process because the market is already there, and any change has to be very subtle and in a very smooth process.
Right.
Otherwise, the disturbance to the financial markets will be very hard.
Mr. Lee, your thoughts on this?
Yeah, you mentioned the political implications of this kind of a policy, and let me refocus the discussion to say who's going to be benefiting from the Warsh maneuver, right? The lowering of rates and the shrinking of the balance sheet. Lowering of rates means that consumers and home buyers will have the likelihood of lower rates and more affordable loans. The banking system, because it'll be drained of liquidity, will be less able to make these short-term loans, but instead the loans will be made by private credit and private debt markets, where the people who are there are more sophisticated investors and are able to take the risks. So essentially, it's shifting the burden of lending more onto the private sector and away from the banking system. And one of the things we learned in the 2008 financial crisis is the more risk you load onto the banking system, the more likelihood of a systemic crisis. So I think for purposes of policy, the mix that Governor Warsh is proposing, which is to shift the burden of risky lending onto the private sector, take it away from the banks, and make loans more affordable for small businesses and for consumers, that's a win-win-win, right? All sides. The policymakers are happy, the business people are happy, and the banks are less happy, right? But in some sense, the banks are relieved that they don't have to go after the more risky lending business.
Interesting. Professor Hu, your response there? What Mr. Lee just suggested?
Oh yes, shrinking the balance sheet of United States Fed is certainly going to decrease the liquidity provision to the world, because U.S. dollar is the currency used by almost every country in its investment as well as trading. So yes, we're going to see the impact of the decreasing liquidity supply from the United States over time. But I don't worry about that too much, because as we said, it's going to be a gradual process. It's going to take a long time to do that turnaround. So in the short run, still, what we're going to see immediately is the effect of lower interest rate of the United States. So that's going to increase the supply of the money. And so as other countries are concerned, I think it's probably everybody is going to be happy to see the change the United States is doing.
So it is having quite a big impact on where Chinese policymakers are heading for and how to interact with the U.S. decisions.
Yes, what we're gonna see very likely, or yes, even immediately, is the lowered interest rates of the United States, United dollars. I'm sorry, the U.S. dollars, and that's gonna help the central bank of China to make easier decision regarding its own monetary policy. Because I think the economic situation in China requires lower interest rates, but before. China is kind of constrained by the interest rate gap between China and the U.S. When they consider lowering the interest rate of China's RMB. But now, since the U.S. dollar's interest rate is coming down continuously, and that's going to help release the space for China to make independent monetary decisions. That's a good news for China's central bank.
Mr. Chen, do you think that logic works?
Well, I think it is good news for China, because right now what China has is deflation. I mean, they've had more than 30 consecutive months of negative growth in the producer price index. So they do need a little bit more stimulation, but at the same time, they have high debt. And that's one of the reasons why I think that when they decide to establish the growth range for China, they're probably going to abandon the 5% growth rate and probably go to maybe 4.5% to 5% to give them flexibility, stimulate the economy. But again, they have some limits as to how much they can lower interest rates. And this will give them a little bit more breathing room on that part. And then they could also add more stimulus, which I think they will do, the trade-in subsidies and things like that, to stimulate consumer spending. So they're going to be relying on several toolkits or several tools to stimulate the economy and get faster economic growth, given the constraints that they're under.
What about the independence of the Fed? That has been so much debated since this president came in to the office and had a fearful debate with Federal Reserve Chairman Powell.
The issue is not about independence, as I said earlier. It's about Fed accountability and limiting Fed mission creep. The Fed shouldn't be doing work and policy making on climate change or diversity and equity and inclusion, these DEI kind of policies. The Fed should focus on central banking. And that's the view that which is monetary policy and ensuring a safe banking system. And going back to that mandate, I think would be a very positive thing. Independence is determined by Congress, not the president. The Federal Reserve Act is what preserves Fed independence. And so long as that is in place, Congress can take away or give independence to the Fed. The presidents, as I said before, every president has said lower rates, lower rates, lower rates. Some presidents, like President Johnson, right, are much more aggressive. President Trump is in that aggressive camp, but nowhere near as bad as Johnson. And Obama and Clinton, everyone has said lower rates. So jawboning with the Fed has been a traditional practice in American politics going all the way back. So I think the independence issue is a non-issue so long as Congress says the Fed is independent, and so long as the Federal Reserve Act doesn't change. Independence is absolutely crucial. Every study, whether it's at the IMF or in academics or at the Fed, has always shown that inflation performance of a country is much better when the Fed is independent. So that is really critical to the credibility of a central bank and the effectiveness of the central bank. What I'm saying is that the attack on Fed independence is overblown in the press because there has been no attack on Fed independence. There's been attack on Fed mismanagement of resources, attack on Fed management of its mission, expanding its mission beyond its mandate. So it's resource and managerial accountability, which is in question. Were the Fed chairman from Janet Yellen back to days of Alan Greenspan? Were they good managers of Fed resources? And the answer that Kevin Warsh and President Trump is saying is that given the mission creep, given the expansion of the Fed mandate, they've been lousy managers and mismanaged resources. That's the attack, not on independence, not especially on policy independence.
Mr. Chen, what does it say to you about the Fed independence? What exactly is it? And how much the executive branch of the government will have impact on the Fed decisions, please?
With the Johnson situation, Johnson allegedly even used violence and actually used physical violence against the Fed chairman. There's another case, and that is the case with Richard Nixon and the Fed chairman at the time, Arthur Burns. Clearly there, that Fed chair did not have much independence. They were getting a lot of pressure from the White House and basically pursued a very flexible monetary policy. And guess what happened? Inflation really skyrocketed. And the reality is that Kevin Warsh is correct in saying we should not be afraid of faster economic growth. What we should be afraid of is economic growth that exceeds potential economic growth. If you have a situation like that, then you can have inflation. But if potential growth is rising, and he believes that it is rising because of artificial intelligence, it could push the underlying trend of productivity from its long-term trend of about 2%, maybe another 1%. And then you even have Kevin Hassett, the head of the National Economic Council, who's arguing that because in the fourth quarter, the Atlanta Federal Reserve is forecasting 5.4% growth, and we had the government shutdown that may have subtracted 1.5%, that the real growth is about 6.9%, almost hinting that we can actually grow at 6.9% without having any inflation. That is a very, very difficult argument for me to be convinced. Because yes, potential growth can go up because productivity goes up another 1%. And in fact, studies by the St. Louis Fed and Goldman Sachs suggest that maybe productivity has got up anywhere from 0.2% to 1%. But productivity overnight is not going to go up 3, 4, or 5% so that we can justify. But Kevin Warsh is correct, and so is Kevin Hassett. Productivity is going higher. All I'm saying is it's not going 4 or 5% higher than the trend. So you got to be careful about how fast you grow this economy. Remember that the inflation rate is still 2.7% and the target is 2%.
What are some of the tools that the Federal Reserve Chairman could have in so-called remain independent? Mr. Chen, once again.
Well, I think that the tools are very obvious, and that is the Federal Reserve has to, of course, avoid all the mission creep that Bill Lee's talked about, but they have to make decisions that are justified by the economic fundamentals. If the markets perceive that they're making policy decisions based on pressure from the White House, then that independence starts to go away. Then the financial markets start acting as though there's no independence. But again, I don't expect Kevin Warsh to be that type of Fed chair. In fact, there was one interview where I saw him actually say that if the president was looking for someone to head the Federal Reserve and not have independence, that they had the wrong person. So that convinces me that he is serious about maintaining. Now, he's talking about lowering interest rates, and some people get a little bit nervous, but I think it's because he feels artificial intelligence is going to add to productivity, so it gives them the flexibility to lower interest rates. But if he sees that at some point lowering interest rates is leading to even higher levels of inflation, I think he will pivot and not go down to the 1% federal funds rate that the president has been advocating for a long time.
Professor Hu, what do you think is the so-called Fed independence? What is Federal Reserve independence, and how much significant is it for outside for not just the United States, the rest of the world?
Well, independence for central banking is required by the working logic of central banking, because history has proved that if we don't have central bank independence, it's likely to be negative, and it's even possibly a disaster. So it is well recognized. Also, it's well protected by the legislation. The Federal Reserve Act has already given the independence protection for the Fed. So I don't think the basic, the foundation is still there. Plus, the view held by Mr. Kevin Warsh is also guarding the independence. He has called it operational independence. So I think so far we don't really have to worry about the independence of Federal Reserve. Back to the issue whether independence means the Fed has to be always different from the president on the policy view. That's not necessarily true. What we see is that for the next 1 year or so, the policy orientation of Mr. Kevin Warsh is the same as the president. That is lowering the interest rate. But obviously, I think Mr. Kevin Warsh is going to be very watchful on the inflation issue. If there's any sign of possible inflation hiking, then I think he's going to take action. He has already won the trust and credibility from the market.
As we know, whoever will be the Federal Reserve Chair is going to serve during a time when the world is experiencing some dramatic changes when it comes to geoeconomics and geopolitics. And certainly, as a result of that, we're going to see economies trying to adjust to one another. Currencies, a big question also. So how does that add another extra layer of responsibility and requirements of sound decisions to the Federal Reserve Chair? Mr. Hu, your thoughts first.
We're maintaining a strong dollar, a credible dollar is always the goal of the United States as a whole. Also, this responsibility relies on the work of Federal Reserve. So I think the major goal of Fed is to maintain a strong dollar or also a stable dollar. And one thing is to control the inflation rate very tightly, so that it's not going to hurt the value of dollar. Everybody has confidence in holding dollar. That's going to maintain the U.S. dollar's position in the international arena. And geopolitical tensions certainly have heightened the awareness of everybody, and especially in the Federal Reserve, that it has to maintain a very credible dollar for the United States economy, as well as in the political arena in the international game.
Mr. Chen?
Well, I think maintaining a strong dollar is important. And I think that's why the financial markets got a little bit nervous when the president was asked about the value of the dollar. And because it was declining, and he said the dollar was just doing fine. So that got people a little bit nervous. But we also have to keep in mind that the Federal Reserve's responsibility is not directly to influence the dollar. That responsibility is with the U.S. Treasury. And of course, when Chairman Powell was asked that question, he did reiterate that very clearly. But in pursuing good economic policies, the dollar should be held pretty strong. And if you have low inflation, and the other mandate of the Federal Reserve is to have healthy economic growth, then the dollar should be pretty strong, assuming that the Treasury is not pursuing strategies to lower the value of the dollar, which historically it has not done that, unless there's been an exceptional circumstance out there.
Mr. Lee.
The Treasury Secretary is the main person responsible for preserving the credibility of the dollar. And that means keeping the fiscal deficit contained, keeping the debt from growing excessively, and ensuring people that if they buy Treasury bills, they're going to get paid back. And they're going to get paid back in the same value that they bought it with, which means the international value of the dollar has to be stable or predictable. And I think that's the element. I think that's the challenge that faces the Trump administration and China for that matter, because China also wants its currency to be internationalized, the renminbi to be used as a transaction vehicle around the world. Now, I think China's got a few more hurdles to cross, like making the currency more convertible and allowing different types of regulatory changes to take place for international capital flows. So, but that's in the pipeline, I'm sure. So the superpowers are dealing with maintaining their currencies, but the challenge is that all of these middle countries are looking for different ways to find different transactions medium. In my mind, the bulk of the challenge is with Treasury to have the deficit, which is why the tariff revenues have been such a joy for Treasury to be say, hey, we've got more sources of revenue now to pay for these high expenditures.
Maintaining a strong dollar sometimes is a little bit confusing. Maintaining a strong dollar, there are twofold of meanings. One is maintain the credibility of dollar.
Yes.
That is the responsibility of Fed. Maintaining a strong dollar in the sense of higher exchange rate that's the responsibility of the Federal the Treasury Department. So that is the different aspects of U.S. dollar. When we talk about geopolitical tensions, usually we mean the credibility of the U.S. dollar rather than the exchange rate of the U.S. dollar. Sometimes lower interest exchange rate is even better for the United States in international trade and investment.
And thank you for your insights. Hu Jie, Anthony Chen, William Li, appreciate it. Thank you.